Yesterday we were talking of how to identify just uh, randomly how to identify the order flows. But in today's video now, I will now be showcasing, like, because yesterday we were just mapping the order flows, either mitigated or not. And yeah, just to get to know how to mark the order flows. And I said things like the order flows need to be marked on the impulsive move. Like I'm not expecting anyone to mark the order flow on the corrective move. They should be marked on the impulsive move. So yeah, we covered that, and also we said that there can be a bullish order flow and a bearish order flow. A bullish order flow are only marked when we are in an uptrend, and a bearish order flows or bearish order flows are marked when we are downtrending. And I said also for these order flows, there can be order flow that is mitigated and another one that is unmitigated. And for those two kind of order flows, we are only interested with the ones that are not mitigated or the unmitigated. The ones that are mitigated, we usually ignore them. So in today's video, we'll now be diving into the unmitigated ones, and on those unmitigated ones, which one will we be using, or which one will we like yeah, of course, right now we are heading on how to know, like, where price is actually getting the reversal from, or where price is likely to reverse from. So of course, we are anticipating that price will reverse after interacting with a point of interest, and an order flow, of course, is a point of interest. So in a trading range, it's not always that you may find that there is only one unmitigated order flow or two unmitigated order flow. Sometimes you may find that a trading range contains more than three, or yeah, more than two. That is, I mean, three, four, five, yeah, five order flows that are present on the range. And you'll be like, which order flow exactly am I to use to take this reversal, or which order flow will give me that ultimate reversal towards the break of structure? So that's what we'll be covering in this video. And yeah, so right now, this is something that I want you to know. Like, an order flow is primary and order block is secondary. So today we are covering about order flows. Yeah, the order flow is primary. So this means that not until all the order flows are invalid, we cannot use the order blocks, because the order blocks is a secondary option. And obviously we know that the secondary options come after the primary option. So this is an order flow, and I've said that is primary. So you start on your trading range, you start by marking the order flows and make sure that all the order flows are mitigated, because I said that if they are mitigated, we are not interested in them because they are invalid. And so once you have seen like all of them, they are mitigated, now that's when now you get into the secondary option, which is the order blocks. Now that's when you identify the order blocks. But in today's video, we will not be diving into the order blocks. We'll only be interested with the order flows. We'll only be diving into the order flows. Right, so another thing, there can only be a maximum of two valid POIs. Yeah, of course, an order flow is a POI and an order block is a POI. So you can see this one here, order flow is primary and order block is secondary. So first you mark your order flows, and if there is no any order flow, now that's when you get into the order block. So valid POIs. So in case there is order flows on the trading range, this means that let's say there is two order flows or more than that. Now, how can you identify the ones that are valid? Because there can only be a maximum of two valid POIs, or I can just say a valid, like two valid order flows. So in a trading range, let's say there is more than three. So the ones that you will need to identify, or the ones that will be valid in that range, there will be only two unmitigated ones. So how can you identify them? That's what we'll be diving today. And let's say now there is no any order flow on the range. This means that all the order flows are mitigated. So in that case, now that's when now you'll be marking the order blocks. But also the same happens even when the primary option, that is the order flows, are all mitigated and we are only left with the order blocks. Still, the same rule apply. There can only be a maximum of two valid order blocks in an impulsive move or trading range. Of course, the extreme POI and the decisional POI. So by a POI, it can be an order flow or an order block. It depends with what the trading range has given. All right. So right now I will continue like running price until we get into the current price, and then after that now we will start from here marking like or identifying the valid order flows on that impulsive move. Yeah, so that's what we'll be doing. But right now I will continue we will continue marking the order flow just like we did yesterday until I reach a certain point where I have got a good data size. Then now we can filter out the ones that are valid and the ones that are invalid. All right, so let me delete this first. So yeah, control. Let me get rid. Oh, why did I do that? All right, anyway, not bad. All right, so onto the current price, of course, exactly right here. So yeah, let me run price and see what price will do. So right here you can clearly see we marked the order flows pretty much clear here, all the order flows, and in this case now, yeah, so the case that I was actually showcasing, because this one is a change of character. As you can see, there is a major inducement here, so this means this is a change of character. And in this case, or in this impulsive move, you can clearly see that all the order flows are mitigated. So this means that if all the order flows are mitigated, this means that the primary option is invalid, and now we'll be diving into the secondary option. Now the secondary option, like I said, is the order blocks. So now in this case, you will now be identifying the order blocks because all the order flows are invalid or all the order flows are mitigated. So now in this case, now that's when you identify the order blocks. But if there is even one order flow that is unmitigated, in that case you will need to wait for that one order flow to fail before you mark the order blocks. I hope I'm pretty much clear with that. So yeah, let me now run price and yeah, we continue marking the order flows so that I can get a good data size. Yeah, so right here we can clearly see this is a breakout structure, and this means that this here is our trading range high, our new trading range high. And right here we said after the breakout structure, the next step is usually marking the inducement, and I can clearly see the inducement is right here. The reason as to why I'm using this one as the inducement is because you can clearly see that this one here is not a valid pullback, and we said that we only use valid pullbacks. I believe by now, or I want to believe by now, each and every one of you is like a pro in identifying like valid pullbacks, because that's the thing that you need to be like a master at before you actually dive into other concepts of True SMC. All right, so let me continue running price. All right, so price is retracing back. Let me increase the speed of these candles. All right, exactly right here. You can clearly see price went all the way and took out this minor inducement and an extra major inducement. If you clearly remember when I was discussing about major and minor inducement, I said that you can clearly see here there is no any other pullback that price created after this minor inducement, and this, the reason as to why I'm calling this minor is because it was before the breakout structure, which is this one here. So this means that the trading range high will be now the major inducement. And if you clearly remember, I said that if there is a minor inducement, the trading range high, in this case it's a high because we are bearish, the trading range high or the external liquidity will now be our major inducement. And so if price retraces and sweeps that major inducement, that will be now a major inducement sweep and not a change of character. In this case, I consider this here, even though it was a break by a week, a change of character, because we can clearly see that this range had major inducement. So let's say price created a major inducement right here. So let's say price created another pullback down there, meaning the range will be having a major inducement. In that case now, I will consider this as an early sign of change of character. But since this here is the minor inducement and this is the major inducement, because the trading range high is the major inducement, or the external liquidity is the major inducement in this case, then this one here, you can clearly see this is a sweep and not a candle close. In fact, a very nice sweep, because price just wicked above and gave that beautiful rejection. So in this case now, this is just a major inducement sweep, and we don't consider this as a change of character. So this means that this one here is now our trading range low, and I will now be anticipating that price will continue all the way till the break of this low. Right, so exactly right here, that's what I'm anticipating. And by the way, this trading range was confirmed after price took out the minor inducement, not after the major inducement, after the minor inducement. So if price went all the way after the minor inducement was taken out, this one here was confirmed as a swing point. All right, so right now let me continue running price and see what price unfolds. And exactly right here, you can see price is heading towards the opposite external liquidity, and eventually I'm anticipating a break, and exactly you can clearly see that's the break. And right now we are in a new trading range. The reason is why I didn't mark the order flows here is because we said that we only mark the order flow after the inducement is taken out. And you can clearly see here, this here was the minor inducement, and this here was just a single candle. So the candle went all the way towards the major inducement. So if it had broke like closed here without going all the way there, now that's when I will mark the order flows. But you can see this candle went all the way, taking both the minor and the major inducement. So this means there was no any time, like there was no any space or area or whatever the name I will use to say that I cannot like mark the order flows in that case. So yeah, if you clearly remember yesterday I said not until the inducement is taken out, we don't mark the POIs. Alright, so currently we are in a new trading range, and we said after price has created that new trade, like that new trading range, the next step is usually marking the inducement. And it doesn't matter major or minor as long as it's an inducement. All right, this one here, I cannot consider this as an inducement because that's not a valid pullback. And so right now I'll be using this one here as the inducement because this one here is a valid pullback. And in this case, it's not just like it's a minor inducement because it was created or it was formed before the break of structure. All right, so right now let me continue running price, and the reason as to why I'm not marking the POIs right now is because I'm waiting for the inducement takeout. We said if price creates another valid pullback, we shift there, but this one here is not a valid pullback. I hope the smart ones have already spotted that. Right here, you can see this. Like all of this here was engulfed inside this bearish candle, so there is no any valid pullback in that case. All right, so I'll continue running price. Exactly right here, you can clearly see price is reversing back, and yeah, I'm waiting for the inducement takeout. All right, price didn't. Yeah, I can clearly see that this one here is not a valid pullback. So this means that price has yet taken out the inducement, and this means that I can now shift the inducement to this high. Yeah. So let me continue running price. Right, price is all right. So price did this. You can clearly see that that's now the inducement, and the inducement was taken out exactly right here. Then price literally reversed. So this one here can be considered to be a break of structure to the downside. Right, I can see now price has stopped here. So this means like traders cursor, like the backtesting data, they like it's that's where it's ending today. So probably tomorrow it will extend a little bit further. Yes.
In this case, the inducement is transfer on this bullish and bearish candle.
Bullish and bearish candle. Uh,
Yeah,
right.
yeah.
I know what you mean. Like because this retracement is not made up of like it's not made up of the limit that we said.
Yeah.
The retracing candles need to be at least 3, right?
Yeah.
So this means that I will now shift this inducement from where it is to this high, right?
Yeah. Exactly.
Right. So in this case, now this is the exemption. In this case, you will consider this here to be a valid breakout structure. The reason as to why I'm saying this is because this candle was very big in such a way that it has like taken out more than 5 bearish candles highs. So like you can clearly see like all of this distance price has taken out. Like in this case, like there is exceptions on that. Like even though I said that the retracing candle needs to be 3, there is some exception of that. When the candle is so big that it retraced deep inside the trading range, and yeah, probably took out like the counter candles lows, like, or highs depending with the structure, like more than 5. In that case, now you consider that as a breakout structure. All right, anyways, you can clearly see that price has done that. So, and I'm currently doubting this pullback, because on the live market this pullback here was valid, and I considered this one here to be a valid breakout structure. So in traders casa, I can see that this here was not labeled as a valid pullback. All right, anyways, we have got trading view here, so let me do that real quick. So exactly right here, you can clearly see that this one here was a valid pullback on this here. You can clearly see right here, this here was a valid pullback. You can see, and price took that out, yeah, and made that breakout structure. So the same here. So you can clearly see if I measure this retracement with the fib from the high of that range all the way to this low, you can see this range made it out to the 50% retracement. So you can see it went that deep, and on top of that, you can see this took like a number of candles, like candles highs. So you can see that one, like all of these bearish candles highs, like we are taken out by this big bullish candle going to the upside. You can see all these highs that we are taking in this, like in that case now, like there's exemptions on that. So it's not always that it's like I should be strictly with that. No, sometimes you just adapt with what price is actually doing. So you can see, like guys, this year was a valid pullback here. And also if I shift to forex.com, of which is the alternative, instead of me using sometimes if I'm not using the fusion markets, I usually use the forex.com. All right, on fusion.com is now opposite. You can see on fusion.com right here. All right, I've zoomed. In fusion.com, this one here was not a valid pullback. All right, this is interesting. So forex.com is not a valid pullback. What about Oanda? So let's see USD CAD, Oanda. Oanda also is not a valid pullback. All right, the last one, FXCM. USD, no, yeah, USD CAD, FXCM. Yeah, FXCM too, it was not a valid pullback. So this means that fusion markets, like, yeah, you can see on fusion market it was a valid pullback. So this misled me. So this means that our traders casa information is right. Yeah, because most of the brokers are showcasing this one here to be an invalid pullback. So this means I will not consider that as a valid pullback. Yeah. So right, so this means now, all right, anyways, if I was to mark these, let me see, let me continue running price here. Oh, I said like the price has stopped there, so like, yeah, we can now start marking the order flows. But if let's say I was to mark the order flows, then you can clearly see that this one here is now the order flow, and it was mitigated exactly right there with this move. It was mitigated by this, and all of this is also an order flow. So you can see it's easy to identify, because the buying moves are like clearly seen. And then the next one is this one here. So this one here is just easy to identify. So all right, so now onto our start here, exactly right here. So I said there can only be a maximum of 2 valid POIs in a trading range. That doesn't mean that on that trading range, like it's a must that there should be two POIs. No, in a trading range, sometimes there can be one POI, sometimes none. So depends. Right. So right here, I said that we are all interested with the ones that are unmitigated. So I will be using the ticks and the X. So exactly right here, you can see this one here is mitigated. So that will be an X to us. Yeah, let me reduce size of this thing and change the color to red, symbolizing an invalid, like invalid, yeah. Then for the tick, this one is unmitigated, so tick, and this one here is also unmitigated, so tick. All right, so this one here now, it's not just because this, in this case there are only two that are mitigated, so this means that all of them are valid because there are only two, and we said there can only be a maximum of two. So like in this case now it's easy because there are only two, and of course if there are only two, this means that both of them they will be valid because there can only be a maximum of two. This one here that comes after, so now let's say now there is more than, like there is more than two, so this means 3 4 5, like yeah, in that case. So the way that you'll be identifying those two valid POIs or those two valid order flows is like this. So the first one is the one that is on the extreme. So the one that is on the extreme and it is unmitigated, that's the first one. And you can clearly see this one here was mitigated, though it was on the extreme, but it was mitigated. So that's not considered to be valid. So I'll be considering the one that is on the extreme but is unmitigated. So on the extreme unmitigated is this one. And this is what we call the extreme PY. And in this case, since we have the primary option that is the order flow, now I'll be calling that an extreme order flow. An extreme order flow. Right, and now the second now, though, like this is easy to identify. If you know how to identify the order flow, then this here will be easy to just see it, because you just go on to the extreme of the range and find that unmitigated order flow, and that will be the one that is valid. This one here is the one that I find people getting like uh, like very challenging, but it's not even challenging because the one that comes right after the inducement is taken out, that's the second one. So after the inducement is taken out, like right after the inducement is taken out, that's the one that I'm talking about. That is the decisional POI, and in this case the range is evolving order flows, so that will be the decisional order flow. You can see this one here is the inducement, and in that case it doesn't matter, it can be major inducement or minor inducement. In our case here it's the major inducement, so it just depends. By now I believe each and every one of you knows how to identify between a major inducement and a minor inducement. So this one here, you can see, comes right after the inducement is taken out, so that's the decisional, and the one that is on the extreme, that's the extreme order flow. So we are done with that range, and that's the reason as to why you can see right here price gave like a simple rejection on this decisional, exactly right there. Price gave some rejection, but then later price decided to fail the decisional and gave the ultimate reversal. All right, gave the ultimate price decided to give the ultimate reversal after the mitigation of this extreme order flow. So you can see here, if you had to take this trade now, it would have been easy. We just in this case for me, I would have set a sell limit order because this will give me a good risk to reward, though I'm not talking of the trades right now, but yeah, you can see, yeah, stop loss of course above that high, or if I want to be aggressive, I can just place it above the order flow, and of course the target profit, that's the external liquidity. So you can see that's a good risk to reward. So, and sometimes if I see like it's 4.8, 4.9, or let's say 3.9, 2.9, I usually extend this to make it like a whole number. That is if it's involving the major inducement, because I said the major inducement is more impactful and compared to the minor inducement. But in that case, if it's a minor inducement, I wouldn't recommend you to do this because yeah, of what I'm like, I usually don't recommend this because the minor inducement is less impactful. Alright, so I'm not talking about the trades, I'm just talking about the valid POIs. Alright, so onto this trading range, and you can clearly see where the trading range starts and where the trading range ends. The trading range starts this line and ends. I'm using this dotted line, I mean these highlighters. Yeah, highlighter. You can see this whatever this circle and this circle. That's the impulsive move that I'm talking about. So I said we are only interested in the unmitigated ones. So all the mitigated ones, I'm just keeping X's on all the mitigated ones. So yeah, red X's showcasing that they're invalid, like all of them. So another one that is invalid, this one here is mitigated exactly right here. And is this mitigated? This one here is not mitigated, and this one here is not mitigated. So now in this case, now that's when now we use the tick. So in this case also, it's easy. You can see there are only two valid order flows. So in this case, now it becomes easy to, like, you don't need to think because all of them, like in the range, there are only two, and we say that there can only be a maximum of two. So if there are already two, this means that all the two that already they will be valid. But in this case now, since I have identified the unmitigated ones, I said the one that is, let's say now there are more than two, let's say there are three, four, or whatever the number. We said you identify the one that is on the extreme. This is easy to identify. Of course, you just go on the extreme of the trading range and you find that order flow that is unmitigated, then that will be a valid order flow. And the one that I said that is like the next order flow is the one that comes after the major inducement, or not major inducement. It can be any major or minor, but it's just that I'm more like more of involving trades that involve major inducements than minor inducements. That's the reason as to why you see like I'm always talking about the major inducement. But anyway, it like the next order flow, apart from the one that is unmitigated and it's on the extreme, is the one that comes right after the inducement is taken out. So you can clearly see this is the inducement and it was taken out. And right here, the order flow that is right after the inducement is taken out is this one. And in this case, we can clearly see that price gave that rejection from this order flow that was right after the inducement was taken out. And I said that the one that is on the extreme is what we call the extreme order flow, and the one that comes right after the inducement is taken out is the one that we call the decisional order flow. And in this case, price gave a reaction from the decisional order flow. So the same, if you had to take this entry, in this case, you would have used a reversal pattern. And most of the time, price
Hello,
usually.
can anybody hear me?
Hello, I can hear you.
Yes, one.
Hello.
Yes, sir,
We
we
can
hear
Yep.
you.
hear you.
We can hear you, sir. We can hear you, sir. Right on, sir.
Oh, that's good.
So continue, sir.
Right. So exactly here, we can clearly see this is the decisional and price gave the reaction. So in this case, if you were to take this entry, of course, you would have used the reversal pattern because I'm not anticipating like you would have taken like a sell limit order, or let's say after seeing this rejection, you would have done that and placed your sell like above there. This is unreasonable because your SL is very huge, even though it's the safest, but it's very huge. After all, your target profit is here, so you can see like your RR is very bad. You can see you will be earning like more than, or no, less than you are risking. So in this case, I wouldn't recommend such trades. You need to be risking small and earning more. So this means that your risk to reward must be something like a 1:2, 1:3, 1:to whatever. So in that case, also placing your stop loss above the decisional order flow. This is not the safest, but also it's a kinda safe, but not that 100% safe than the one that I've just like done this one here. But anyway, so you can see the stop loss above there, and the one that is now the aggressive one is now placing your a sell exactly right there. In this case, you would have won the trade by placing your sell right there. So it happens, but this is not the safest sell. It's all a game of probability anyways. So yeah, in this scenario, that's when now we usually decide to go for the lower time frame mitigations, because that will give us a good risk to reward, and that will now be giving us the confidence that even though I'm losing this trade, next time when I win, I will like win big, like way too big, that they will engulf all the losses that I had before. Yeah. So anyways, right here onto the next trading range that starts from this high all the way to this low. Just monitor the way like just monitor the highlighters, the ones that I'm actually using. Those are the ones that I'm showcasing the trading range with. This color, I don't know if it's maroon or brown. Yeah, that's the color that I'm using for the highlighters. And yeah, we usually start with canceling the mitigated ones. We said we are not interested with the mitigated ones, and this extreme one is mitigated, so I'm not interested with it. But this one here is it's not mitigated, so I'm interested with this one. And we can just say that that one here is now the extreme one, because the most extreme was mitigated, and the one that is extreme of the range that is unmitigated, that's of course now the first valid POI, and in this case it's an order flow. Again, coming here, I can clearly see that this here it's all right, this here is mitigated. So this one here is mitigated exactly right there. And so you can clearly see now in this case we only have, so you can clearly see in our trading range we only have, I said that this POI or this order flow that comes before the inducement, we usually ignore this, we usually don't mark this. It's an automatic SMT, like a smart money trap in that case. So you can clearly see that in this trading range now there is only one order flow, like there is no two unmitigated order flow, it's only one. So this means that it's not a must that on a trading range like there should be like two valid order flows or two valid POIs. No, it's not a must. There can only be one, and sometimes, by the way, there can be none. Like you can't find, there's sometimes that you will not find a POI on a trading range. So in this case, luckily we find this one here, and it's the one that now we'll be using as the one to be like the valid one in our trading range. So I'll be waiting for a reversal from here for me to take the entry. So yeah, this here is the extreme. So this means in our trading range there is only the extreme order flow. Right, so right there, but then you can clearly see that price didn't respected that. You can see price just striked above the order flow. It didn't even give a reaction and made that change of character to the upside. So this means we just changed bias from being bearish. We are now bullish. So again, since we have changed bias from being bearish to bullish, this means our trading range, of course, will be aligning with the prevailing trend. We can clearly see it starting from this low all the way to this high. So right here we mark the unmitigated order flows and mitigated order flows. All right, I'm using the X representing the mitigated. That's mitigated. This one here is not mitigated, so I'll tick a tick, and we can clearly see, or can just say that this here is the valid one, the valid extreme order flow, because this is the one that is on the extreme that is unmitigated. The one that was on the extreme is mitigated, so the next that is following on the extreme is this one, which is unmitigated, and so that's the one that will be valid. Coming up again, I can clearly see that right, these are all mitigated. So and by the way, this is something that I need to say also. A valid mitigation is by it's by a valid pullback. If the mitigation is by an invalid pullback, that mitigation is not valid. So that's something that you need to note. You can see all of these we are valid pullbacks, and so the mitigations we are valid, and so this means that all these order flows don't work. Like they are all all right. This yeah, this is mitigated exactly here. You can clearly see right here. If I extend this one, it was mitigated there. So this means that right here there was no any valid yeah, this one here on the extreme, so there is also one POI. So in this case I was waiting for this POI to be mitigated, but then price, as you can see, we said that price will always do what it wants, but for we will only be executing once price follows our system. All right, so exactly here you can see price took out the major inducement, then went all the way up, breaking the structure. So this means we are currently in a new trading range, even though price didn't interacted with that order flow. Yeah, so in this case, but I can clearly see these highs were the same. So this means the order flow still maintains. And I said a valid mitigation needs to be by a valid pullback. So this means that this mitigation here was not valid because it was by an invalid pullback. And so the valid mitigation was exactly, let me, yeah, exactly right here. So right there. All right, am I getting this? Yeah, exactly there. So that's where now the valid mitigation was here. So this here was the valid mitigation, but this one here was not a valid mitigation. So that was the valid mitigation, and now this is the scenario that I was talking about, whereby all the order flows available on the range, they are all mitigated. So this means now we are left with the secondary option, which is obviously the order blocks. And yeah, so I will not be talking about the order blocks now because that's a look of another session. All right, so price, as you can see, took out the major inducement and went all the way, breaking the structure. I explained why I considered this break by a week a valid change of character. Yeah, I explained that. And then the same here, you can consider this. You can clearly see all the order flows also in this range. They were all mitigated. So in this case also, that's when now we'll be using the order blocks, because all the order flows in this range was like they were all mitigated, and so the only option that we are left with is actually the order blocks. Right, I will be covering about the order blocks in the next session, so I will not be showcasing why I will not be showcasing where the order block is and all of that until the next session. Then here I explained why we couldn't mark the order blocks here, because price, you can see this one candle took out the minor and the major inducement at once. So this means like yeah, you can clearly see that we can't mark that because we said we only mark the POIs after the inducement is taken out. And then after that, you can clearly see now in this case, this is the scenario that has been whatever, but I consider this one here to be an invalid pullback because we consider like the charts of multiple brokers, and we found that this one here was not a valid pullback. So in that case, this means that yeah, anyway, even though it was whatever and whatever, I was just marking the order blocks here. This was irrelevant because yeah, price took out that and did that. Yeah, so this, all of this was irrelevant. Oh, now in this case, this here is now considered, I can now consider this here to be a major inducement. Yeah, it's actually depends. You see, this is the thing that this is the reason as to why he literally, or whoever like created this, he literally said that we need like 3 retracing candles. Like this is because of this kind of scenario, because sometimes it's not always that price like creates those 3 retracing candles for which consider that a valid pullback. I mean a valid break of structure. Sometimes price may create 2 or even 1 and be considered that as a valid break of structure. So in that case, now that's when now I will use the Fibonacci and see if the retracement is at least at 8.2, or even it has taken out like how many highs of the whatever. So it's actually depending with you just adapt with what price does. So if I consider this one here to be the major inducement, in this case, when you find it hard, like you find it hard to decide if this here is a major inducement or it's a change of character, in that case I would just advise you to stay in cash and just ignore that pair at the moment and go into other pairs where price action is clear, where you can actually mark your order flows, your POIs, your inducement, like you can identify the market structure. Everything is clear. and stick with that until price becomes clear into this asset or into this pair. Now that's when you can come back. But for now, since you can actually not decide and you're actually guessing if this here is a major inducement or a change of character, or you're actually, you know what I mean. So in that case, I would just recommend you to just protect your capital and just go into other assets where price action is clear. All right, anyway, so let's say this one here is the major inducement. So in that case now, of course, you can see all the order flows are mitigated. And yeah, in fact, on the price action, this year price took out this high. You can see price took out this high. So this year, so we can't. So is this now a change of character or a major inducement? So in that case now, right here, so price we have seen that price has taken out this. So this means that I can confirm this one here to be a low. And so if that's a low and price has taken out that, I have marked the order flow, and we have clearly see that the order flows are all mitigated. So this means that in this case also we will be using the order blocks. So price has already done that. So I'll just be using the price. I'll just be using this to showcase that price broke past that. And this one here is a valid trading range. I mean a valid trading range low or external liquidity. And all the order flows in this case we are all mitigated. So that's when now you use the order blocks. And I said that we usually don't mark this order flow that comes before the inducement. Doesn't matter if it's minor or major, as long as it comes before the inducement, we usually ignore this. And so now that's when now you mark your POIs, I mean your order blocks. So since all of these were mitigated, so now right now you need to find the order blocks that are present on these order flows, because an order block is actually it's a like an order block is a refinement of an order flow, because an order block is a small section inside the order flow. So yeah, so I'll be stopping here. I believe like you have gotten the what I meant. Yeah, it's actually not that hard, very easy. The first one is the one that is unmitigated and it's on the extreme of the range. The second one is the one that comes right after the inducement is taken out. There can only be two valid order flows. It doesn't matter if it's a order block or order flow. It just depends with what the trading range has given. If it's the order flows, then the same applies. Two valid order flows in that trading range are the ones that will be working. And if it's the order blocks that the trading range gave, then we will be using the order blocks, and there will only be a maximum of two valid order blocks in that range that they will be working. So yeah, with that now I believe I explained it like good, and you guys have understood that. And right now I am open for the questions.